You know, Frank, I agree with you because ultimately what I'm seeing is that this looks to be a bear market rally. And the reason I say that is we may have hit peak inflation, but the Fed has not signaled that they're going to stop the rate hike cycle because they want to focus and get to a target of 2% inflation, and we're not there yet. They also want to get a more balanced labor market, and we're not there yet. So they're going to continue to raise interest rates, and that could have a negative impact on stocks. So that's why I'm still seeing that we could pull back from these levels.
Joe, I want to come over to you. I'm going to actually hit you with something, if you don't mind. Savita from B of A, Savita Subramaniam, out with a note today saying that only 30% of bull market signposts have happened compared to 80% from previous bottoms. She's skeptical about this rally. So there's one signpost that she has that has a perfect track record. She calls it the rule of 20, the sum of CPI year over year plus the trailing PE of the S&P 500. When it's lower than 20, when the market has bottomed, our historical bull markets always begin with PE plus CPI that's less than 20. I want to make sure I'm quoting this one right. Right now, we're at about 28 when you put those two metrics together. According to Savita, this is a foolproof measure right here. What do you think about that when you see these quote-unquote, what she calls signposts at 28, when normally it has to be under 20 for the signal to be that we're in a bull market?
I think it's, listen, I respect Savita tremendously. I think it's somewhat complicated, though, and I think it's also important to understand the inclusion of inflation in that problem that we're presenting, and that the Federal Reserve is efforting against kind of combating inflation. So it's a very strong fundamental perspective on the overall environment, and it's one that's fair. I don't disagree with it. But what I do believe is that collectively everything that has gone on, Frank, since the beginning of this quarter is technically driven in its nature. And it's a reaction to Treasury yields on June 14th, finding their peak, falling back from there, getting some good fundamental news from earnings, getting some better than expected views as it related to inflation. And it's somewhat remarkable how perfectly this technical road we've been able to drive down. We went right up to the 200-day moving average yesterday. On Monday, I was on the show. Jonathan Krinsky came on. He said to everyone, S&P 500 challenges a 200-day moving average for the first time and generally gets rejected if the slope of that 200-day moving average is down. Well, guess what? That's exactly what happened. So this is kind of working from a technical perspective perfectly, and it's been the technicals that have driven us to where we are today. And, oh, by the way, guess what? Treasury yields, which were the leading indicator for an improving environment for risk assets, well, you got a 10-year that's pushing above 290 today. Treasury yields moving higher. We woke up and we were greeted with the news with hot inflation coming from the UK. Well, inflation's still a problem. We're still going to have to combat it. So I respect what Savita is talking about. It's a very fundamental perspective. But I think right now is everything's technically driven. And that's why we've got this pause that Jenny's talking about today based on that failure up at the 200-day moving average. Well, let's call it a rejection, not a failure.
Hey, Joe, it's Jimmy. I got a question for you, a general question here. All these rules in technical analysis, some of the things that you're talking about, some of the things that Savita talks about, obviously they're based on historical pattern, and in that regard, they're fact. But I've been wondering if post-pandemic, we're in a brave new world. Now, don't come at me with, telling me I'm wrong because, it's never different. I know the folly of that. But I do still wonder. There have been some rules, if you will, broken. For instance, in the last 3 Fed rate hike cycles, the market went up. I mean, this market went down from the first rate hike. That's just an example. So it's a general question to you. Is it possible that at least some of these rules have been made not applicable by the weird after effect of the pandemic and global shutdown?
Without question, Jimmy, you're correct to think that, and certainly the observation is one that has validity. My response, though, when thinking about technicals, is you have to think about the growth of non-discretionary funds. They're all rules-based. They're all telling investors that emotional behavior doesn't work well in investing. So they're just, what are they doing, Jimmy? They're reacting to price. They're reacting to the movement of price. They're reacting to the slope of price. And overwhelmingly, we've seen what we call quant models grow within the industry. Now, you could dismiss that. You could say, well, you have to look at fundamentals. Okay, that's fair. Or you could take the other side of it and say, well, price drives everything. That's fair as well. But from my standpoint, because they're the overwhelming majority of participation in markets right now, you kind of have to pay attention and respect what they're doing. And I don't think that you could dismiss their activity within the market. And it's never been more clairvoyant than what we've witnessed since the beginning of this quarter. Because I don't think, and Jim, I think you would agree, I don't think there's any fundamental change right now. Maybe a little bit better corporate earnings, maybe a little bit of improvement with inflation, but we still have an adversarial Federal Reserve. We still have a dramatic amount of problems. Last point on that, and this is how you can't disrespect these non-discretionary funds, these rules-based funds. The price of oil, the spot price of oil, is now spending its 11th day below its 200-day moving average. That's remarkable. And guess what? A lot of these non-discretionary funds, they're actually short. They're actually short crude oil futures, which to me seems to have no logic based on the fundamental environment. But that just supports the premise of what is dictating their action in the market.